Now, today we continue with our discussion on financial markets, and then we will move to the next topic: financial instruments, products, because these two are basically very closely related. These instruments are traded in the market, so we have to discuss those instruments as well. Before we go to that, I think from the last week we have some slides pending. So we will start with today on the international financial markets. Now, international financial markets. Now we have already seen there are two types of instruments basically traded in the markets: the bonds and the equities. So in the international market also, we can observe these bonds and equity traded in the international financial markets. Now, if you look at international financial market, there are three type of bond instruments traded mainly. And there are, as a result, there are basically couple of key markets in the international financial market. One type of instrument is traded, or the traditional type of instrument traded in the international bond market is the foreign bonds. Foreign bonds are, as I said, they are very traditional instruments traded in the international financial markets. How do you define it, foreign bond? They are sold and denominated in foreign currency. For example, you can have USD bond, sterling bond, yen bond. Likewise, it is denominated in the foreign currency very clearly. Second type is euro bonds. This is a recent innovation. Recent innovation means it's not that traditional compared to foreign bonds. So euro bond is denominated in a currency other than, this should be that, then that other than that of the currency in which it is sold. It's a bond denominated in currency, in other currency than the currency in which it is sold. Now, for example, the best example for a euro bond is ISB, International Sovereign Bond. Now, this international sovereign bond, now for example, Sri Lanka issues an ISBLK, let's say, issues ISB. Now, if it is issued by Sri Lanka, generally it should be LKR, rupees, right? Because it belongs to the Sri Lankan government. But these are denominated in other currencies. Could be in LKR, sorry, USD, could be sterling, etc. And these are traded in international markets. For example, our Sri Lankan international bonds, sovereign bonds, are sold and traded in Singapore markets, European market, American markets. Likewise, they are sold in the foreign territories. Now, this foreign bond that even can be sold here in foreign currency. You should not need to go to the international bond market. You can sold it here and basically traded in, if it is accepted in international markets, you can trade it there also. But the most important instrument here, I would say, the euro bond, ISBs. The best example is ISBs. Then we have another type of bond. They are called as euro currency. Even if it is called as a bond, it's actually currency deposits. These currency deposits deposited in banks outside the home country. For example, this came, I think, originated in US. For example, they deposited US dollars in foreign banks like European banks. I think this especially happens during this Cold War period. I hope you have heard this Cold War. During that period, there was a struggle between the USA and Soviet countries, Soviet Union. So the USA was basically under threat, and they were scared that USSR, Russia, Soviet Union might attack them. So as a result, they have kept part of their money outside the US banks. They deposited such money in European banks, in London, in Frankfurt, likewise. So when you deposit your own currency for in others outside the home country, it becomes euro currencies. As I said, euro dollars are the most famous currency because US dollars deposited in foreign currency outside the US, especially in European banks. These are some variants for international bonds. Among these, the most important thing is the euro bond. You have to keep that in mind. What is a euro bond? What are the examples? As I said, the ISBs are the most important examples for European or euro bonds. Okay. Then international stock markets. As I said, the other type of instrument traded in international markets are the stocks. Why international stock markets are important? MNCs, multinational corporations, they raise capital in the global equity markets. Multinational corporations means companies operating in various countries in mega scale for producing goods and services. Now, for example, Coca-Cola is a multinational company. Sony is a multinational company. Likewise, they are operating in many countries. So, how they expand their businesses? Basically through raising capital from the equity markets. Right? Now, until recently, for many years, the US market was the largest stock market in the world. In the US, there are various stock markets, key stock exchanges in New York, in Chicago. Likewise, there are main stock exchanges. So those were the key markets until recently. But now, in the past couple of decades, Asian stock markets have become very important, or they have grown fast. If you look at this chart, these are the largest global IPO markets in 2019. IPO means stock issuances, issuing stocks for the first time. I think I remember you remember we discussed this primary market. In the primary market, when you issue stocks for the first time, you call it IPO. So based on the IPOs of 2019, you can see most of the Asian stock markets are in the list. For example, Hong Kong, Shanghai, Shanghai Star, both these are Chinese stock markets. Shenzhen, that is also a Chinese stock market. Again, Shenzhen Chinex, another Chinese stock exchange. So likewise, you can see out of this 10, half of the stock exchanges have performed well in Asia. And other than that, the USA stock markets, London stock market, German stock market, Stockholm, Sweden stock market are also in the list. But if you can observe very closely, the Asian markets have become very important. Now, in international stock markets, when we monitor, we look at some key indicators. Uh, all these markets have their stock indices. For example, London Stock Exchange, they have their own index, Frankfurt Stock Index. We monitor them. Among these, most important stock indicator or the price index we consider as the S&P, S&P 500, and also sometimes we look at Nasdaq. Both are US indicators. So these two indicators provide the the broad direction of the global stock markets. If you look at this, I have presented here S&P during lockdowns COVID period last year. The S&P recorded a biggest loss. If you extend this into the 2006-7 period in the crisis time, you will see there was a large drop in the S&P stock exchange. So likewise, we can monitor S&P stock index. We can monitor these indices to get some idea about the global stock market movements. Now let's look at the financial markets in
Excuse
Sri
me, sir.
Lanka. Yes,
What is the meaning of the Sri Lankan development bonds?
it's an instrument issued by Sri Lanka government in foreign currency. In foreign
Issued,
currency, in
issued by
issued
Sri
in
Lanka government.
government. Yes, it's in dollars, but issued by the Sri Lankan government. I think I have some slides on that in the next session, right? Then we'll have a discussion.
Okay, sir. Thank you.
Now, if you look at Sri Lanka stock financial market, it has a fairly long history, especially with the capital markets. Capital markets, the operation started in Sri Lanka around 1880s. The Colombo Stock Exchange, the Stockbrokers Association was established around 1889, more than 100 years ago. But it was not that developed and not active. But these early stages of financial markets, capital markets, we can observe in Sri Lanka. But the most modern type of stock market operations in Sri Lanka dates back for around 3 decades. I think 3 or 4 decades, starting from 1980s when the economy was liberalized. We can see the Sri Lankan capital market became somewhat active, especially the stock market. Okay, and in Sri Lanka, the very clear regulatory, institutional, trading, clearing, and settlement infrastructure have been fairly well established. Regulatory means relevant laws are there. Institutional means relevant facilitation is there, right? Whether it's by uh, the central bank, by the stock exchange. Likewise, there are some clear institutional responsibilities given. Trading means that stock exchanges, trading boards, they are actually established. Clearing and settlement means, I think I discussed under payment and settlement, the scriptless security settlement system, CDS, Central Depository, those are there to facilitate the clearing process. And also, many components of the financial market are also in place. Whether they are not in well-developed scale, but all key financial market components like the money market, foreign exchange market, capital market, debt market, all these are there, right? But we need to have some, kind of a development, modernization, and reforms in order to establish a active financial market. Some financial markets are actually not that developed in Sri Lanka, especially the private debt market, corporate debt market is not that developed. The stock market is active, developed, but it's not, basically reaching the remote areas. Uh, the bond market, that is also developed, trading is happening, but it's not. I mean, it's only with the institutions. People are not exactly, attracted by the bond markets. Only few people invest in treasury bills or bonds. Most of them rely on what? deposits, right? If you think about yourself, you are also basically based on the deposits. That is the main instrument. Some few people who would like to take some risk go to the stock market and do some investment. So that part has to be developed in Sri Lanka. But other than that, these markets are in operation to some extent. What are the key markets we can identify in Sri Lankan market? Sub-markets. We have a very active money market. A foreign exchange market is there. Government securities market is there. Private debt market is there. Equity market is there. So all these key markets are there. Outside these, we know there is an informal financial market. Informal financial market means that does not captured by the formal sector. As I said last week, we know there is segment in which is not under the direct observation, no supervision, no regulation of the government. For example, you cannot regulate these informal money lenders, right? You cannot regulate certain activities in certain, market areas. For example, in the manic market, fish market, there are, some informal money lending, borrowing happening, but we cannot regulate them. These are under the formal segment. As I said last week, that also provides some service for sure for their for people's daily cash needs, liquid needs. They are supporting, but only thing is those things will be there until the formal market is well developed and also that captures or serves the each and every segment of the society. Let's look at a couple of these markets closely. In Sri Lanka, if you take the money market, in money market there are various markets operating. Mainly, there are two players in the money market. One is the market participants. The other one is the central bank. Central bank is intervening in the money market by way of its open market operations, right? The monetary operations. So central bank conducts monetary operation in various ways. They conduct long-term auctions, short-term auctions, overnight auctions. Why? This is to provide liquidity or to absorb liquidity. I think you remember we use these terms repo and reverse repo facilities by the central banks, which means either to inject money or to absorb money. So these operations are performed by the central bank. That is having some impact on the money market, right? So that's why we have included this table in the central bank annual report. These monetary operations, market operations by the central bank is having an impact on the money market. But if you take purely from the market perspective, the market participants in the money market, we can observe two sets of markets. One is coal market, the other one is repo market. If you look at this table, the money market is divided to coal market and repo market. Mostly these markets are overnight. Overnight means the transactions are happening on 1 day basis. You borrow or lend for a period of 1 day and you settle on the following day. Amongst the two markets, the coal market is the most important market. Why? That facilitates the liquidity management of the economy, especially by fulfilling the requirements of banks. Banks need money on a day-to-day basis because customer transactions are happening. When the customer transactions are happening, sometimes bank might be experiencing more than expected withdrawals, more than expected deposits, more than expected borrowings, more than expected repayments. Likewise, for a particular period, they are expecting certain transactions, and if the transactions are not based on the expectations, there could be requirement for having money or there could be excess money. That's why you call it excess liquidity and deficit liquidity in the banking sector. So these monies either they borrow to fulfill or they lend to others if they have an excess. That is happening in the interbank cold money market. So this is a very active market depending on the liquidity levels in the banking sector. Liquidity level means excess money, as I said, right? And short-term interest rates are very sensitive to this in this market because that is reflected by the liquidity levels. I think you have heard the term the average weighted cold money rate, AWCMR. Remember why this rate is important? What is this rate, AWCMR? Can somebody tell me what is the AWCMR, average weighted cold money rate? What is the significance? Can remember anyone? In the monetary policy discussion, can we remember we mentioned in the monetary policy discussion? Yes, somebody has sent a message. I think I can't see it. Does anyone want to raise your voice? It's the operating target of the central bank. Remember, central bank is conducting monetary policy to manage this cold money rate, average weighted cold money rate. That average weighted cold money rate is decided by the borrowings and lendings in this coal market. And this rate is very sensitive to liquidity levels. So when there is less liquidity in the market, less money in the market, on that day, coal market goes up because most banks demand money. If the liquidity level is in a surplus, which means there is more money in the system, excess money, the average weighted coal money rate goes down because there is less demand for funds. So that's why I mentioned this is a very important market. And monetary policy changes are first reflected in this market. For example, if the central bank raises policy rates, SDFR and SLFR, that is first reflected where? In the coal money market. Because that is the most close market to the central bank. Central bank does not do transactions with the public, no. So it does transactions with the banks. So if the central bank is changing its policy, that is first reflected in the rates borrowed and lent to with the banks. That's why I said it is reflected first in the interbank market. So in any country, this is a very important market that decides the short-term movements of interest rates based on the liquidity levels. If you look at numbers, even in Sri Lanka, compared to repo market, the coal market transactions are high. These are annual volumes. You can see the rates are really high. Now, I have not given you a definition here, but what is the repo market? Can someone tell me? Any idea? Sorry. Repo market means now in the coal market, only banks are operating, right? In the repo market, not only banks, primary dealers, and EPF in Sri Lanka, they are also in the repo market. Okay. And some other institutions, they also do repo through some custodian banks. They cannot directly come to this market. They also do a repo with some other bank. So in that sense, this market is also helping to fulfill the needs of the institutions in the financial markets. especially institutions who require money on a daily basis. Banks and the primary dealers. Primary dealers are dealing in government securities. So they also need money on a daily basis for the transactions to support government security market because it's the largest market. So they also transact in the repo market. Now there is one clear difference between coal market and repo market other than these institutions. Can someone tell me?
So can you repeat again the question again?
There is a key difference between the repo market and the coal market other than these institutions. I told you, in coal market you have only banks. In repo market you have banks, primary dealers and selected other institutions like EPA. That is one difference. What is the key difference between these two markets, coal and repo? Any guess?
Uh, Call money market provide the lending within with customers,
Hmm.
and repo market dealing with the financial institutions or banks when they
Uh,
need money.
no, again, I'll make it clear in the coal market, banks are fulfilling their needs. Banks. There's no direct link with the customers. Customers are dealing with the banks, no? So their needs are not fulfilled in the coal market. Due to the transactions with the customers in the coal market, the banks might be borrowing or lending depending on their liquidity level. Again, as I said, in the repo market, not only banks, primary dealers, EPF, they are fulfilling their requirements in the repo market. That's one difference. But other than that, I'm searching for the key difference between these two markets. Any other answer? Any other view? Hmm?
Repo market includes securities?
Exactly, yes. Repo market involves securities. In the coal market, no securities. What do you mean by security? To take a loan, you have to have a collateral, isn't it? If you are taking a loan from a bank, you have to have a collateral. Either you have to have a house or a vehicle or some other asset. If it is not secured, you call it unsecured borrowing, like credit cards, personal loans, they are unsecured. So these coal money market transactions are unsecured, uncollateralized, which means no security. That market is purely based on the trust among banks. No, only few banks are operating, and you have 100% confidence on the banks. Because if you don't maintain the confidence in the market, you cannot survive. So in the coal market, only the interest you pay, no securities deposited. Okay. But in the repo market, you have securities. Treasury bills or treasury bonds are kept as collaterals when you are borrowing. Clear? Any question on that? Any questions? Clear now? Let's move. Then we have the foreign exchange market in Sri Lanka. In the foreign exchange market, we actually call it domestic foreign exchange market. So if you want to make it very clear, you may say domestic foreign exchange market because this is operating in the domestic economy. So this market, interbank forex market, is the place where currencies are traded between the banks. Now, even in this market, you have banks. Right? Customers are not there. Customers are there beyond the banks, which means if you take this into a kind of a small diagram, you have customers, they are dealing with banks, right? So these transactions are happening between the customers and banks. Banks are fulfilling their requirements in the FX market, foreign exchange market. For this market, customers do not have any access. Right? Only banks are in this market. That's why you call it interbank forex market. When the banks are supplying foreign exchange and buying foreign exchange or demanding, the rate is determined. The exchange rate is determined there. In certain days, you might see banks are demanding more foreign currency for various reasons, to pay imports, to pay their customers, for various to make investments. For various reasons, banks are demanding more currency. In certain days, banks are having surplus currency. For example, you get remittances, you get export conversions, you get other inflows, investment inflows, then you have some forex liquidity. So that determines the exchange rate in the forex market. This exchange rate determination in the forex market is also reflected or related to the net open position in the foreign exchange of licensed commercial bank. This term is very important, net open position. Why? That indicates very simply the difference between forex assets and forex liabilities of banks. If the forex asset, forex liabilities difference is positive, you call it a positive net open position. If the liabilities are greater, you call it negative net open position. When the market is positive, net open position is positive, the banks are not facing much pressure in terms of the exchange because that indicates assets are higher. When there's a negative net open position, that indicates you are short of foreign exchange. Then there could be some pressure on the exchange rate to depreciate, right? So this daily net open position of each bank is very important factor in determining the foreign exchange. That indicates whether you are having surplus currency or shortage of currency. So we already mentioned it is determined in the exchange rate. In this foreign exchange market, as I said, mostly banks are operating, but central bank might intervene into this market to avoid variations or large volatility in the exchange rate. How does the central bank intervene? Either supply FX or purchase FX. When system is surplus in terms of foreign currency, the central bank might purchase foreign exchange. When the central bank is having a shortage, the market is having a shortage, the central bank might supply. I think you are aware recently the central bank has supplied some foreign currency to the market for facilitate importations because there's a shortage. Okay. Now, not related to this, I hope you follow the financial press as I advise, right? Do you follow the very closely? Have you have the habit or do you have the habit basically to look at the newspaper, web and central bank site for daily financial information. I hope you have it, right? Because that keeps you alive, keeps you updated, and also knowledgeable about these developments in the financial market. So in this highlighted area, I have provided you main functions in the foreign exchange market, converting currency and one currency to another currency. I think it's very understood. Minimize risk arising from changes in the exchange rate. Now in this exchange market, there are various type of transactions. Remember, we discussed spot transactions, term transactions. Similarly, there are forward transactions. There are swap transactions. I'm going to define this in the next slide, next session. These are derivative products. Why there are derivative products? To minimize the risk. Remember, we discussed under various risks, there is a market risk called exchange rate risk. The changes in the exchange rate will have some impact on the prices. Or it would lead to generate some losses. To minimize it, you can have various derivative products like forex swaps and forex forward transactions. Foreign exchange market facilitates funding imports, converting export proceeds. I think I already mentioned other foreign exchange transactions are happening. So in the Sri Lankan market also these are happening, but we have very small foreign exchange market compared to some other countries. On daily basis, our volumes on average 50 million US dollars. Our daily transaction is a very small amount, right? Because our market is not that big, so there are some limited transactions happening. Then the government securities market, another important market in Sri Lanka. I already mentioned to you last week also. The government securities market can be divided into primary market and the secondary market. Primary market is basically determining or facilitating the government funding needs. I told you why there is a need for government to have government securities, because government is running a deficit. Revenue minus expenditure, they have a budget deficit. So this budget deficit have to be financed internationally or locally, or through the banking system or through the non-bank system, or based on the available resources or through borrowing. So in that case, they need to have this government securities market, GSEC market, you call it GSEC market, to borrow funds. So in the primary market, the government issues securities for the first time. First time in the sense, to the primary dealers, securities are issued in the primary market, either bonds or bills or development bonds, whatever first issued in the primary market. Okay, there is a primary market for ISBs also. I told you we have international sovereign bonds. This primary market is not our primary dealers. This is in the international market. The first issuance in the international market is also called as a primary market, but there are no involvement of primary dealers, the local primary dealers. Okay. And the secondary market is very important because that determines the tradability of the government securities market. Now, as I said, the primary dealers, they first buy government securities from the primary auction, that is through the central bank auction, and after that they sell it to the investors. That selling part or buying part is happening in the secondary market. Now in Sri Lanka, the secondary market was not that active and liquid for some in the past, but now as there is a kind of an interest in the invest in the government securities, so you can see some increased transactions. In the past, what really has happened for people who have bought securities, they just kept with them. For example, large funds or institutions like EPF, insurance, they bought instruments, government securities, and kept with them. But when the primary dealer system was introduced around 2000, that those primary dealers, they actively started trading in the secondary market. In Sri Lanka, treasury bonds are the main instrument. If you look at our portfolio, the size of portfolio, the majority of the instruments are treasury bonds. Treasury bonds means more than 1 year to longer period, right? And investors' preference is also there for government securities in terms of foreign currency. Someone asked these Sri Lanka development bonds. These development bonds are issued in foreign currency for foreigners and expats. And banks are also investing because they have foreign currency with them, right? If you have foreign currency with you, you also can buy these development bonds through a bank or a primary dealer. They are in FX. Our government securities market is open for foreign investors. Earlier it was closed. Now I think during last 10 years time it was open for foreigners. So foreigners can come and invest in the government securities market in Sri Lanka up to 5% actually. Now this is changed to 5%. Right? 5% of the total stock of T-bills and T-bonds they can purchase by foreigners. That is facilitated in Sri Lanka. So here we have some information on the government securities market in terms of yield rates. I think we discussed this thing to some extent. We basically monitor the movements of government securities market through the movements of yield rates. So this T-bill yields means actually the interest rates for government securities. So you can see how these rates are moving: 91-day bill, 180-day bill, 364-day bill. We cannot have this continuous series for T-bonds because T-bonds are not issued on a regular basis. T-bills are issued weekly. It's a kind of a rollover facility to the government. So they are issued weekly. But even if weekly, you can see in some ways there are, blank spots, which means for certain weeks, certain maturities have not been basically issued. They are issued, but they are not basically accepted at the auction. So this continuous series is available only for short-term securities. But we have another instrument or strong element, we call it yield curve. Remember, yield curve also we discussed, that represents the direction of interest rates. Now in the yield curve, you have up to 1 year to 15 years or even more than that if we have 30-year bonds. This is reflecting the secondary market transaction. Now yield curve is plotted as the interest against the interest as well as the period, tenor. So on this axis you have the interest rate for the bond. On this axis you have the duration or the maturity of the bond. So based on that you can plot these and you get a kind of a curve. It could be a flatter curve, inverted curve. I think we discussed this concept to some extent even in the previous session. In the next session also we will be covering this to some extent. So the movements of yield curve, you can see there are parallel shifts upwards and downwards that indicates the movements of interest rates. So if interest rates in the economy going up, the yield curve is moving upwards. If interest rates going down in the economy, yield curve is moving downwards. Typically in a yield curve, short-term rates are low, long-term rates are high. So which means there is a natural upward sloping yield curve. That is the most typical yield curve. So even in Sri Lanka, most of the time we can observe this upward sloping yield curve. But depending on market expectations, right? That is a very important term. The shape of yield curve could be different. For example, as I said, against this typical upward sloping curve, yield curve could become flatter. Yield curve could become inverted. Inverted means short-term rates are high, long-term rates are low. So those shapes could be there depending on the market conditions, but this is a very good indicator to monitor the market preferences and their activities in the government securities market. Then we have the corporate debt market. Corporate debt market means the private bond market, private sector bond market. This market actually in Sri Lanka is very thin and at very developing stages. Even we don't have some good numbers to measure this. If you look at this table, you will see here we have some numbers for based on GDP. If you take the government securities market as a percent of GDP, it's around 35%, even more than that now. But if you look at the corporate debt market, it's only 2.5, 2.1. It's a very small market. Even in terms of transactions, you can see in terms of billions, the highest transactions we have seen up to 2015 is 83 billion. So very small. But this is a very important alternative source of funding, right? For the private sector to expand their businesses. Not only they can rely on equities, they can use debt as an important instrument because this is a long-term instrument. Borrowing by issuing a debt instrument means borrowing for long term. And the main instruments used in Sri Lanka are the commercial papers and the corporate debentures. Corporate debentures means issued by, well-established or listed companies. Commercial papers are traded among big entities, right? Debentures are traded in the stock markets actually. You cannot issue debentures without going through the stock market. So debentures are listed. Commercial papers are not listed. Here I have given you the details. Debentures are listed on the debt securities trading system of the CSC. CSC means Colombo Stock Exchange. So this market has a large room to grow. There's a large space to develop this market, corporate debt market. Then let's come to the equity market. Equity market means very simply the stock market in Sri Lanka. In the stock market, we have around 286 companies listed representing 20 business sectors. Right? These 286 companies for various businesses. Could be banking, could be leisure, could be footwear manufacturing, could be transportation, could be various goods, right? Productions. Likewise, there are various business sectors as 20 and around less than 300 companies operating. Sorry. How these are operating, doing their trading, it's actually at the Colombo Stock Exchange. This is the main stock exchange. But other than this, there are exchanges in Mathura, Kandy. I hope there's one in Anuradhapura also. So these are some regional stock exchanges to facilitate transactions. So the main exchange is located in Colombo. This is regulated by the the Securities and Exchange Commission. That is the regulatory arm. Like central bank regulating the banks, the Securities and Exchange Commission is regulating the Colombo Stock Exchange. Now, in the stock exchange, there are two main systems. Central depository system, I think you have some idea. We discussed the CDSs. That is actually facilitating the transactions and doing the settlement and act as a depository to retain records. ATS, automated trading system, helps to do transactions. It's an electronic board. In the past, I think I mentioned to you, there was a manual intervention in the stock market. People who want to buy and want to sell, they manually meet there through the bidding and asking prices. But now it's actually a automated process. You enter bids or ask into the computer, to the system, and that will be reflected in the board. And when the transactions are matched, the transaction will happen. So this is one of the key developments in the Colombo Stock Exchange, introducing a automated trading system. In Sri Lanka, right now, the market capitalization is around 3,950 billion, which means closer to 4 trillion rupees market capitalization. Right now, in 2021, these are the most largest companies in Sri Lanka in terms of market capitalization. So you can see the highest company has around 6% of the market capitalization. It's LOLC, and these are the first 10: CTC, John Keels, LOLC Development Finance, Expo Lanka, Dialogue, Commercial Bank, Distilleries, Browns, Nestle. Likewise, you have 286 companies, and these are the most largest companies in the market. And when we monitor the stock market performance, like we monitor these yield curves in the bond market, we look at some certain indicators, key indicators in the stock exchange. Remember, I told you in international markets, we monitor S&P 100, 500, NASDAQ index, likewise. But in our case, in Sri Lanka, we monitor two major indices to gauge the performance of the stock exchange. One is all share price index. The other one is S&P Sri Lanka 20 index. All share price index, we call it ASPI. It's a market capitalization weighted index where the weight of any company is taken as the number of ordinary shares listed in the market. So in this all share price index, we consider the share price of particular company, let's say company X, their share price and their number of shares. Price and number of shares into 286 companies, right? You look at the all markets, all the institutions on a particular day. You take individual all these prices and their number of trade shares in the market, and you do a weighted average index to calculate this ASPA. So in simple, ASPI measures the overall performance in the stock exchange. Overall performance in the stock exchange. So if you look at the ASPI these days, you can see the ASPI is on an upward trend. I think you are aware these days our stock market is, performing well. It's booming. There's a greater interest towards the stock market. People are buying securities stock in the stock market, and when you purchase more securities, the stock prices are going up, indicating ASPI is going up because your price, this price variable goes up. So that measures the overall performance. S&P 20 index, now this does not tell you ASPI what are the best companies or what is the performance in terms of best companies, right? So in the S&P index, you take the 20 largest and most liquid stocks. Largest means from the size, which means this table, you take 20 companies of this table up to 20, and you not only the size, you have to see whether those stocks are being traded. So you look at their tradability as well as size, and you calculate a similar index based on their prices and the number of shares to see the performance of these largest and most liquid companies. So ASP measures the overall performance, S&P measures the largest and most liquid companies in the stock market. again, if you look at numbers these days, this S&P 20 is also an upward trend, which means those 20 companies are performing well. So these price indices, you call it price indices, measures the performance of the stock market in terms of the price of the stocks and the size or the relative importance of the company. Okay, these are the key indicators. Other than that, there are some sectoral indicators. I told you in Sri Lanka there are 20 subsectors in the stock market: bank finance, beverages, construction, chemicals, diversified, hotels, healthcare. Likewise, across various segments, you have different subsectors. So in Sri Lanka, you calculate 20 sub-indices for these sectors. Why it is important? It reflects the performance of the each sector. Now, for example, as an investor, you would like to know these days what is the performance in the uh, tourism sector, which means the hotel sector. Similarly, someone would like to know what is the performance in the power and energy sector, because investors, they would like to have more information, what are the profitable sectors. So in that sense, calculating these sub indices will be an important for the investors to understand the trends in certain broad sectors. There are some more indicators in the stock market. One is total return index, TRI. This TRI is calculated in addition to the price indices. Now, this TRI captures two things. Not only the price changes. Now, in a stock, you get two types of income. One, capital gain. The other one is dividend. Capital gain means the difference between prices, current price between the previous price. Dividend means the cash income, cash flows, right? TRI means, now in the ASPI, you only look at the overall prices. In the TRI, you take both these capital gain plus dividends into consideration and calculating the total return of a particular stock, and you take the overall. In other words, very simply, you can calculate this thing, the change between the previous ASPI and today's ASPI, and you add up the dividend income to that. That's a simple idea. Right? Total return index. When you say the word total, that indicates both the price changes and also the dividend income. Why this is needed? This is indicating the overall performance, and which is important for the investor. He would like to see whether the total returns are on an upward trend or a downward trend, whether it is positive or negative. He would like to know. That's why this is calculated. So the stock exchange, they calculate this total return index and publish this information. And there are some other indicators who would be which are very important for the investors. Now, this ASPI is important not only for investors, that is important even for the policymaker, for the government, for the central bank to gauge the overall performance. But if you are an investor, you would like to have some more information on the stock exchange. There are some micro indicators like PE ratio, right? PE ratio is price earning ratio, is ratio between the valuing a company, it's used to valuing a company based on the current share price and its earnings. You look at the current share price of a company and their earnings to see whether that company is doing well, whether it is valuable to invest or it is undervalued. So do you, need to invest this, whether should be a profitable thing. That can be measured by this PE ratio. How do you calculate this? You divide market value per share by the earnings per share. So investors look at this PE ratio, as I say, to understand whether the company is profitable or whether it's having a long-term prospect. Those are measured by the PE ratio. The other one is dividend yield. I think there is a mistake. You should correct it. It should be DY, dividend yield. How do you calculate dividend yield? It's expressed. A dividend is expressed as a percent of current share price, right? dy. Dividend is expressed based on the current share price. That will show how much dividend is paid by this company, because some investors, they will invest expecting a cash flow. Some investors will invest having a long-term view, which means they don't need to have regular cash flows. They will need to have a growth of the share, which means the price is increasing. When you realize the price at some day when you are selling it, you should gain some capital gain. There are some investors like that, but some are investing expecting dividends. Then when they expect dividends, they look at this dividend yield, whether the company is paying any dividend compared to its current share value. So these two indicators mostly important for investors, right? I think with that we are done with the markets, and I requested you to look at the questions last week. So I hope you have tried those questions. And I thought before we move to the discussing these questions, let's also look at the other part of this discussion, the financial instruments. Now we have looked at the market very widely, and we will also look at the instruments in a similar way. Then we have a perfect understanding on the markets and instruments. That will be helpful to understand these questions and answers very well, because there are some questions in these past paper questions that we need to do some calculations for instruments. Okay? So in that sense, I think it's better we discuss instruments as well. Then we'll try some exam questions. Would it help? What do you think? Have you tried the questions by any chance, students? Did you answer the questions? I think I requested you to do so last week. No response, which means not done. Can I ask you to try them, please? Then we can have some discussion. Exam dates are not fixed yet, but they indicated today it will be in January, right? Not perfectly fixed, but there is a plan to have the exams in January. So which means we roughly have 3 months. So hopefully by end of October or early part of November, we will be finishing our discussion. And there will be, I think, a revision session. So you have plenty of time, enough time for you to get prepared for the exam. Let me open the next slide set. Then did you get the slides we have uploaded last night? You have it?
Yes, sir. Yes, sir.
Okay, right, great. So this is an extension to the previous discussion. Earlier part, we mainly looked at the markets. Now here we are basically expanding that into securities and products as well for us to understand the nature of such products very closely. Okay. Now in a financial system, there are various instruments traded. By the way, what do you mean by a financial instrument? Markets we have defined, these are the spaces or the platforms or the place where you do a transaction. Instrument means basically a contract that creates a financial asset to someone and a liability to someone else. In other words, it's a tradable instrument or an asset of any kind. Could be cash, evidence of for ownership, could be a certificate, right? Likewise, there could be various forms. But very simply, when you are trading a financial instrument, you are entering into a contract with the other party. What type of contracts we have? Financial contracts we have. We have deposits. That's the most common financial or the traditional financial instruments, deposits and loans. Then we have treasury bills, bonds, commercial papers, debentures, corporate bonds, asset-backed securities, leasing and hire purchases, shares, derivatives, and there could be many more. But here in this slide, we have captured the most of the instruments. Now in this session, we are going to look at the features of these instruments very closely. Let's start with the deposits. Deposits, I think you are very familiar. We all have deposits. It's sum of money placed with a financial institution for the credit of the customer account. So we deposit or place money with a financial institution. Now I hope you remember various financial institutions we discussed who take deposits. Banks, non-banks, credit unions, thrift societies. Remember, there could be various building societies. There could be. So, can you hear me?
Sir.
Okay,
Yes.
sorry. I got a call on my landline, so sorry. Then, remember, as I discussed, there are various types of institutions, not only the banks, non-banks, credit societies, thrift societies, building societies, credit unions. In various countries, there are various institutions. Depending on the institution, the service could be different, but what you do essentially, you deposit some money under as a credit in your account. There are various types of deposits, and mainly three types of deposits can be observed, especially the demand deposits, saving deposits, and time deposits. Demand deposits can only be observed in the banks because banks are only allowed to have demand deposits, which means current accounts. Savings deposits, they are actually helping to mobilize savings on short-term basis. And for liquidity purposes, you have a savings account for your liquidity purposes, which means for day-to-day utilization for transaction purposes, you have these savings deposits. Fixed deposits, time deposits are there for investment purposes, right? You enter into a fixed deposit or having a fixed deposit as an investment for a period of time. Call deposits are also there. They are also like kind of hybrid instruments. Hybrid means it's like a demand deposit or a saving deposit. Again, helps for day-to-day liquidity management. Now, here I have given you the definitions for each and or the characteristics for each and every uh, instrument. Now, demand deposits mainly used for transaction purposes. Funds can be withdrawn on demand. You can have money at any point, right? Using a check. You can nowadays even you don't need to have a check. You can transfer money from one account to another account in the current account, right? But only thing, this does not earn any interest in the demand accounts. Current accounts, you don't have any interest paid. But there are some important services provided to demand deposit holders, which means you have a checkbook, check facilities. You can use it for standing orders. Standing orders means you specify a certain amount to be credited during a specified time frequency. Even you can have ATM cards or debit cards, credit cards based on your current account. And another important thing I have not mentioned, these demand deposit holders have OD facilities, overdrafts. Overdraft means you can withdraw money or utilize money more than the available money amount of money in your account. Bankers would know there are term overdrafts, temporary overdraft for this purpose. Okay, it's a kind of a special facility given for demand deposit holders. For the central bank, these demand deposits are really important because this is the source of money creation. Money multiplier works very well with these demand deposits. Okay. Savings deposits, they earn an interest calculated on a daily, weekly, monthly, or annual basis, which means, remember, we discussed this effective interest rate concept. If it is daily, if it is weekly, you can convert and see whether it's making what is the effective rate compared to the annual rate. So this is applicable for savings deposits. Funds can be withdrawn. You can withdraw money from your funds at any point. Earlier, we know there was a passbook. Now it's actually most of these savings accounts are e-savings account, e-passbooks are there. Even without the passbook, through the internet banking or online banking, you can change money position, you can transfer, you can deposit, even you can open new deposits through online mode. And also savings deposit holders get other facilities like ATM and debit cards. Fixed and time deposits, I told you, funds are placed for a specified period, which means an investment. The return you earn is higher than the savings deposits because you keep money for a certain period of time. And these FDs could be short term, medium, or long term. Short term means it could be minimum, I think, 1 month FD. Long term means, I think in Sri Lanka, mostly 5-year FDs are there, right? So from 1 month to 5-year period, you can place funds depending on your preference. You can earlier actually withdrawing FD, it takes some time. You have to inform the bank in advance and you have to wait for a while. But I think nowadays within a shorter period of time, you can withdraw an FD, but you have to give some advance notice to the bank that you are going to withdraw because bank has to arrange money for you, because these are invested in other long-term or other purposes like loans. But what happens if you are prematuring the FD, if you are withdrawing prior to the agreed maturity date, you pay a penalty. Penalty means your FD rate is reduced to the savings rate mostly. And one of the important things of this FD is that can be used as a collateral to borrow. Against an FD, I think you can borrow up to 90%. Loan to value ratio is like 90% you can borrow if you have a FD with a bank. So it's like a very secured way of borrowing, because the security is already there with the bank. So banks are very, I think, eager to lend based on the FDs, because there's no risk for them. Call deposits are also there. It's like both savings and checking account. Call deposits are mostly 7-day deposits. I think even in Sri Lanka we have some small amount of call deposits. No fixed deposit period, but mostly in Sri Lanka I have seen there are 7-day deposits, and provide instant access to funds like a demand deposit, unlimited withdrawals and deposits. And also you get some interest on this based on the period of money left in the account. You get some accrued interest based on the call deposit as well. So all in all, the most important types of deposits in these slides are the demand, savings and FDs, that is used for mobilizing money by the financial institutions. The other traditional instrument compared to the deposits is the loans. I think you're also aware of these loans. Here we have defined a loan. It's a specified sum of money provided by a lender, typically a financial institution, to a borrower on the condition that it is repaid either in installment or advance at agreed dates and agreed rate of interest. So when you give a loan, it's like an entering into a contract. The borrower would pay you in installments or advance. Some loans you might be basically paying at once. For example, these credit card loans, mostly you pay at once. Sometimes you pay small amounts, but principle is you have to pay at once in a credit card loans. But there are some loans you go into a installment basis. For example, if it is a housing loan, you pay as installments. If it is a car loan, it's like installments, right? Mostly installments. That installment covers capital as well as the interest component. In a typical loan, when you pay this installment in terms of capital and interest, it's like this. If this is the start of the loan, if this is the end of the loan, at the beginning you pay a large interest and small amount of capital at the start of the loan. When you are going through the loan period, gradually you are reducing the interest component and you are paying the capital more, right? That is the typical setup of a loan. When the banks are pricing a loan, it price in that way. First they recover the interest, then they recover the capital gradually. And most of the banks or the financial institutions they need a security for these loans. There are some unsecured loans as well, but mostly they require a kind of a security. The cost is recovered in terms of the interest. If you look at the types of loans, there are secured and unsecured. Secured means you basically have to have some asset. As I said, these are the most common type of loans, secured loans. You keep a property, you keep a moving asset, likewise a car, or you keep a fixed asset like a house or a land. to borrow. The bank is having a kind of a security in the case of a default of this loan. Unsecured loans are mostly monetary loans that are not secured by any asset. So banks are using or providing these facilities to actually to diversify and attract borrowers. Unsecured loans are given to attract borrowers, because if you are only having secured loans, your borrower base would be limited, because people with some asset or a security will come and borrow from you. But for the short-term funding needs, people might borrow from you without any security. For example, as you already know, a credit card is an unsecured loan. There's nothing as a backing if you have a credit card. Only thing, when you apply for a credit card, sometimes bank will ask for a kind of a recommendation or a guarantee. Even now, I don't think it's there. You can simply have a credit card if you have a very good credit record. So it's very easy now, which means this unsecured loans can be accessed very easily. Personal loans are unsecured loans. For example, people borrow for 2 years, 3 years for personal needs, not for investment purposes like housing or vehicles or whatever. Personal loans are basically to facilitate some your temporary cash needs. These personal loans are unsecured. There is no security involved. Mostly the guarantor would will provide a guarantee that you will pay. ODs using current accounts, they are also unsecured loans. When you take a unsecured overdraft, there's nothing as a backing by a collateral. Now, in the previous session, I told you these money market loans in the coal market, they are also unsecured loans. I told you there's no security in the money market. And there are some other types of loans as well. Subsidized loans. Subsidized means a loan on which interest rate is reduced. What you are paying is less than the market interest rate. Let's say the market interest rate is 8%. You are getting the loan at 5%. So the interest rate is subsidized by 3%. So the importance is this 3% is borne by someone else in a subsidized loan. It could be the bank, or it could be the government, it could be a third party like central bank. It is basically, borne by someone else. For example, these agricultural loans, student loans are like subsidized loans. Even this COVID period, the commercial banks lent at 4%. At reduced rate compared to the market. So it's a kind of a subsidized loan. And there are some concessional loans, which means granted in terms of more generous than market loans, either through below market rates or at a grace period or combination of both. Some loans are there provided for a longer period. And out of that longer period, a certain period is exempted for paying interest or any installment. Now, for example, G to G loans. G to G means government to government loans. They are mostly concessional loans. Foreign institutional loans like ADB loans, World Bank loans, IMF loans, they are concessional loans, which means you are paying less or for a longer period with some grace period. Syndicated loans are there. Syndicated word indicates a collection of investors. A financing offered by a group of lenders for a single borrower, arranged by lead managers. Lead manager means who's basically supporting the loan arrangement. Now, syndicated loans are mostly government loans. So when the government borrows from international markets, they go for a syndication. Why they go for a syndication? Now, for example, let's say the government wants $1 billion. $1 billion cannot be borrowed easily because it's a large amount. So you go to a lead manager, which means could be an international bank. That international bank would arrange a syndicate for you, for the government. What is the syndicate? This 1 billion, he will raise from various investors in small portions, maybe 200, 500, 100. Likewise, you take a pool of investors who would like to lend to the government, and you collect this 1 billion and lend to the government. So mostly government loans are, government direct loans are syndicated loans. Governments can issue ISBs also to raise this 1 billion. They can want, if they want, they can issue an ISB. So these are instrument based loans, but syndicated means it's a direct loan raised from the market through these lead managers. Then we look at debt and equity. I think we had some discussion on the debt and equity market in the previous week and in the previous session. But here we look at the features of these instruments very closely. What do you mean by a debt instrument? We already seen it's a contract, right? When you have a debt instrument, for example, you can keep some examples here, then it will be very clear. Bonds, either private or government. Loans are debt instruments, right? What are the features of these instruments? There's no ownership interest. Having a bond means you are not an owner of a company. If you have a corporate debt instrument, a bond, you are not the owner of that company. If you have a government bond, you are not the owner of the government. Likewise, there's no ownership. Creditors do not have voting rights, right? In debt instruments, there's no voting. Why we are saying this? Because in the case of equity, you have voting rights. That's the reason. Interest is paid, and that interest is actually considered as cost of doing business. So what you pay or receive as interest is the cost of doing business. And when it comes to accounting, this interest cost is tax deductible. That is very important in terms of debt instrument. Creditors have legal recourse if interest or principal payment are missed, right? If you don't get your loan back, or if your issuer does not pay your bond, you have the legal authority, legal right to take an action. But if a company or even the government has issued excess debt, that could lead to some financial distress and bankruptcy. So in finance, we have a kind of understanding. If you have more debt, that increases your risk. High debt, high risk. So in finance, we say if you have large leverage, more debt means you have large leverage. In other words, you call it debt to equity ratio. You measure leverage by debt to equity ratio. So compared to equity, if you have more debt, which means your leverage is really high, that indicates you are more risky. Right? You're more risky. Equity. Equity means stocks. Or shares. You have a kind of a ownership if you have a share or an equity. Even if you have one share, you have the ownership. Now probably you may have seen some people, they only keep one share of a particular company. Why is that? To keep the nominal ownership of that company. Depending on the number of shares or the percentage of shares you have, you might be considered as a minority or majority shareholder. But even if you have one share, you are an owner of that firm. Stockholders or shareholders, they can vote, which means you have voting rights to elect board members or any other issues. You are an eligible person to vote. In the case of equity, what you get is dividends. You pay dividends, but it's not a part of cost of doing business. Right? Dividend is a cash income, it's not the cost of business. And dividends are not tax deductible. When you do accounting, when you pay taxes, you have to pay taxes for dividends. For interest, as I said, you don't pay taxes. And dividends are not a liability of the firm until it is declared. Right? Companies are not required to pay dividends. It's not a liability. It only becomes a liability when it is announced. When you say that you pay a dividend, then it is a liability you have to pay. Otherwise, company can decide, the board of directors can decide whether a dividend can be paid. And shareholders have no legal right, even if the dividends are not declared. Now here, we know if your interest is not paid, if your principal is not paid, you have legal right. But in the case of shares, you don't have a legal right if the company does not pay a dividend, because you are also part of the company. And we mentioned to you, when you have high debt, you are more risky. Similarly, when you have more equity, you are not risky, right? In the case of debt, more you have debt, we told it's risky. Risk goes up. In an equity firm, when you have more equity, it reduces the risk, which means it reduces this leverage ratio. Leverage ratio, debt equity ratio is reduced when you have more equity than the debt. Any question on this? Students, are you there?
It's clear, sir.
Clear now? Now let's move to these instruments more closely, debt instruments. Out of these debt instruments, loans we have already covered in detail in the previous slide. Now we are going to look at the bonds very closely. We already know bond is a debt instrument, and that's a certificate showing that borrower owes a specified sum. If it is a government, the government is liable, or it owes to pay a specified sum to the investor. Bond is referred to as a fixed income security. Why? You pay a fixed amount of cash or money to the investor. So a bond, a government bond or a private bond is referred to as a fixed income securities. Why these are issued? Principally to raise capital, raise money from investors for the activities that you are undertaking with a promise to pay in future. Now, governments are actually borrowing for their day-to-day needs, but actually that indicates if they are borrowing for long term, They are raising money for the purpose of raising capital to undertake government activities. For example, long-term projects, long-term facilities are basically supported by these bond issuances. Bills, they are taken for short-term liquidity purposes. But if you look at this from a company's perspective, companies always raise debt or bonds, issue bonds for the purpose of expansion. Corporate bonds are issued for the purpose of expanding the company, so which means it's used as capital. In a bond instrument, which means in a fixed income security, we have some important features. What are these features? It has a coupon rate. Coupon rate means a kind of an interest rate. Right? Based on this interest rate, you get a coupon payment, that is basically cash. So in a bond, you get cash income. There's a face value. Face value means the issued value. Issued value mainly in 100 multiples. Could be 100, 1,000, 10,000. Likewise, there are various multiples to issue these bonds. There's a time to maturity. Time to maturity means there's a fixed period for the bond. Could be 3 months, 1 year, 15 year, 30 year. Likewise, there's a fixed period compared to an equity. Equity, you don't have any fixed period, but for bonds you have a fixed period, time to maturity. Now, when we are calculating a price for this bond based on time to maturity, what you take is the remaining maturity. That we have to understand. Remaining maturity. Now, for example, you have a bond issued in 2010 for 15 years. If it was issued in 2010 for 15 years, it should mature in 2025. So at the issuance, the maturity was 15 years. But let's say you are trading this bond today. This is 2021. Now, what is the maturity of the bond? It's not the 15. Maturity is basically 4 years because you have only remaining 4 years. So you have to take the remaining maturity time period as the maturity. There's a required rate of return, which means this is the cost of the bond. The interest rate, the actual interest rate is given by the required rate of return. We call it yield to maturity. YTM means yield to maturity. This is the interest cost of the bond, not the coupon rate, right? Coupon rate is different. Coupon rate is used for calculating the coupon payment. This is actually the cost of the bond. Then the bonds are tradable. As I said, most of these bonds are having a secondary market. You can trade the bond. Now here we try to understand the cash income of a bond. There are two ways that you can make money out of a bond, either earning interest or capital gain. Earning interest means you can generate cash flows. Capital gains means price difference. Very simply. You can have interest, cash flows, or capital gains, which means the price difference. Now here we have an example. Let's say we have a 1,000 rupee bond. This 1,000 rupee means what? From our knowledge, face value. Okay. It pays 6% for 5 years. This 6% is the coupon interest rate, not the cost, right? If you have this bond, you get 6% for 5 years. 5 years is what? The maturity. If you hold that bond until the end of this term, known as the maturity date, how much you will collect? So we can understand this from a timeline. If you draw a timeline for 5 years period, you can understand this. So the principal, the face value is 1000 at time 0. Okay. Now this bond, if you hold with you, every year you get 6% as the cash income. Why? The coupon rate is 6%. So 1000 into 6% means you get 60 in the first year at 6%. So this first year. Another 60 in the second year. Another 60 in the third year. Another 60 in the fourth year. And in the last year also you get a 60 as cash income. So if you add up all these cash incomes, what you get? Around 300 is received as the cash payments. Okay. So at the maturity, what you get is, in addition to this 1000, you get another 300. So total principal and the interest at the maturity is becoming 1300 at the end of the 5-year period. When the bond matures, you get 1300 in principal. Okay. Now this 1000, the face value at the end of 5-year period, it could be different. Now you issued at 1000, but end of 5-year period, this 1000 could be different. For example, your capital gain could be different, changing depending on the change in these prices. Now let's say after 5 years period, your bond has increased to 1100. Then how much you get as the capital gain? 1000 minus, or 1100 minus 1000, which means another 100 is earned as the capital gain. That is in addition to this 300, isn't it? So you get cash flow 300, you get capital gain 100. So this is the total return of the bond. This could be other way around also. At the 5-year period, your bond could become 900. Then you are making a loss of 100. Negative 100 is your capital gain. Now your total return is 300 plus minus 100, which becomes 200. So what you are saying is, if you having a bond, you get both interest as well as capital gain depending on the price changes for a bond. So here we have the formula to understand that. We call it holding period return. So holding period return, RT, is actually expression of capital gain and the cash flow against the original price. PT minus 1 is the previous price, original price. PT minus 1 is the capital gain, the price difference. Cash flow is the total cash income you received from the bond. Now in the previous example, cash flow was 300 And if your bond value has gone up to 1100, 1100 into minus 1000 means your capital gain is 100 against the value of the bond, original bond, 1000. So this concept is referred to as holding period return of an asset for a period of time. So holding period return is composed of two things: capital appreciation over the change, cash income. Okay. So when people invest, they will look at this return. Whether you are making an adequate return, you do some calculation.
Sir, excuse me. Sir,
Yes,
who decides this the price change of a bond, sir? Whether it's a capital gain or a loss, how do we decide that?
it's actually depending on the market conditions. No one decides. The key factor, it's a very good question. Key factor behind this price change is the interest of the economy. Now, I told you this required rate of return, this YTM, this is actually based on the interest in the economy. So if interest rates are changing in the economy, this bond value 1000, this is changing. You buy 1000 today at a particular interest. If interest rate goes up in the future, this 1000 will be less valuable in the future. Now don't ask me why. To show that, we have to do some calculation which is not under your discussion. Bond valuation we don't do. Okay, so if you do a bond valuation using the bond valuation formula, when interest rate is changing, this 1000 is changing. If interest rate increases, this 1000 would become 900. If interest goes down, this would become 1100. So that's purely based on what? The interest rate changes. So no one decides. That is basically from the changes in interest rates in the market. Does that answer help?
Yes, sir. Thanks.
Okay. Right. I think, yes.
Excuse me, sir. I have a doubt. When we investing on the fixed deposit, if the interest rate is changed or not, that particular period bank has to pay. But in the sense of we are depositing on the bond, it's a different fee, isn't it? According to the interest rate, it will be the change.
Yeah. Now,
There is no any agreement between that.
no, that's why in a bond you have these cash flows. Cash flows is the assured income. Now in this case, you get 300, isn't it? That is your assured income. That is agreed. That will not change. But only change will happen in terms of the capital gain. Capital gain cannot be assured. That is based on market. So capital gain, either you have to accept a loss or a profit. Okay. So I hope it's clear. It purely happens because of the changes in market interest rates that leads to understand this bond prices interest rate relationship.
So excuse me, one more question. Now, when we talk about bonds, now you showed us one example. No, it's 6% interest. So now let's say first year it's 1000, then plus 6% interest, 60 rupees. Then for the next year also, so is it the fixed interest rate for 1000, or there is no any method to calculate it? Let's say for the second year 1000 plus 60 rupees, then 1060. Not
Again,
like that, no, sir?
Yeah. No, it's a very valid question. Again, it's a very good question. What happens? The issuer of the bond will not pay you like accumulated interest, which means not effective. He will pay you 1000 into 6% always, right? But what will really happen? Sometimes you will not redeem the coupon, you will not get the coupon back. You will reinvest it. When you are reinvesting it, you get accumulated interest for that 60. Next year again 60, you invest that. You get accumulated interest for that 60. It's a separate thing. But the issuer of the bond will pay you 6% every year, that is 60 rupees. It is fixed. At the beginning of the bond period, it is fixed. Clear?
Thank you.
Okay. So I think that's very good questions. 2 questions are really valid. It makes very simple and very easy for me to lead. Go to the next session, next part. So here we discuss the relationship between bond prices and interest rates. I think it's almost 10 o'clock, 5 minutes more. We may wind up at this point because I need to explain this clearly next week. Then you will see when the interest rates are going up or going down, the bond value changes. When the bond value changes, your bond might be a profitable bond or a less profitable bond, purely depending on the interest. That we will do next session. Okay, we don't need to rush too much because we have some space now, because we know exam is not in a hurry.
Excuse me, one more.
Yes, go ahead.
Sir, one more request, sir. One more request. Now, just as additional help, just for the information, sir. Is it possible for you to show us some samples, like treasury bill, like this? So just few samples, sir.
Again, very good question.
Yeah,
but now what really has happened in the past, I'll show you some samples, no issue. In the past, we had these treasury bills bond samples because it was script based. It's like a certificate. Nowadays, these treasury bills, bonds, stocks, they are not certificates anymore. They are like computer entries. You only get a computer statement. That's it. So we don't have any, proof to show in modern time. Only computer entries and the statements. But I'll show you some samples next week, what we had in the past as treasury bills and bonds. Is that okay? Okay.
Right, sir. Thank you very much, sir.
So guys, let's stop at this point. We'll meet next week and continue our discussion. And make sure you also work with me, do some past paper questions, watch financial news, listen to news, search web. That is also really important. Okay, and I'm happy I see a large number of people joining this class, even in this early morning. That's really good. Let's continue with our discussion and we'll do some good work. Thank you. Let's stop at this point.